Welcome, everyone. Have you ever wondered how a country can completely rewire its economic engine while it's literally still driving down the highway? Well, if you're a focused learner looking to synthesize the entire Malaysian financial landscape, you are in the exact right place. Today, we're taking a massive amount of information, summarizing multiple lectures covering everything from central banking and money markets to equities and sukuk, and we're distilling the whole shebang into one comprehensive high-level explainer. We're going to map out the entire dual financial system of Malaysia. So let's dive right in. How does a country successfully run two completely different financial systems simultaneously? I mean, think about it. Malaysia doesn't just have your standard conventional banking system governed by normal interest rates. No, it operates a fully fledged, parallel Islamic financial system, governed strictly by Sharia laws side by side. It is a phenomenal structural feat. It requires massive regulatory firewalls and intense operational discipline, just so the two systems don't bleed into each other and create some kind of systemic chaos.
To really understand how these two systems coexist without colliding, we need a solid mental model. So think of the entire economy as a massive, complex vehicle. Bank Negara Malaysia, the central bank, well, they're the driver, right? Steering the macro economy. The short-term money markets act as the gears, managing the daily flow of liquidity so the engine just doesn't stall out. And then you've got the long-term capital markets, your equities, your bonds, acting as the wheels, physically driving wealth and the whole economy forward.
Okay, here is our roadmap for today. We're going to break down this massive vehicle layer by layer. Number 1, the foundations of the system. 2, short-term money markets. 3, equities and capital markets. And finally, number 4, bonds, sukuk, and debt. All right, let's get rolling.
Section 1. Foundations of the system. The driver and the blueprint. We've got to begin with the central bank and the guiding rules of that Islamic track.
So, the Central Bank of Malaya Ordinance officially established Bank Negara Malaysia back in 1958 with a core mandate to issue currency, act as the government's banker, and basically promote standard monetary stability. But if you look at the history, there is a massive gap between 1958 and 1983. 1983 marks the establishment of the very first Islamic bank, BIMB. Why the huge delay? Well, because building a true Islamic system meant creating totally new legal frameworks completely from scratch. Then, 1994 was an absolute game changer. Malaysia pioneered the Islamic interbank money market. This meant Islamic institutions finally had a way to trade liquidity with each other without even touching conventional interest rates. Fast forward to 2020, and we're seeing massive digital innovations like the sukuk prihatin. This whole journey was a very deliberate, step-by-step construction of a parallel financial universe. But what actually governs that parallel universe? It's Sharia, which is Islamic law. Now, it derives from primary sources like the Quran and the Sunnah, but what's really crucial to understand here is its absolute pragmatism. It utilizes secondary sources too, like maslahah, which essentially translates to public interest or welfare, and earth, meaning local custom. This is so vital because it proves Sharia isn't just some rigidly ancient text. It's a dynamic, highly adaptable blueprint. It's designed to serve the public good, all while dictating exactly what is mandatory, what's permissible, or what is completely prohibited, like riba, which is usury or interest.
Let's really look at the difference here. Conventional banking is fundamentally interest-based and debt-centric. If you borrow money, the risk is transferred largely to you, the borrower, end of story. Islamic banking, on the other hand, demands profit and loss sharing through highly specific contracts. Take a mudarabah contract, for instance. One party provides the capital, the other brings the labor or expertise, and they share whatever profits are generated. Or take musharaka, which is a true joint venture where both sides provide capital and share the exact risks. In this system, money itself is not a commodity that you just trade to make more money. No, it is purely a medium of exchange, and it has to be backed by tangible assets. So you see, these aren't just different rules. They represent fundamentally distinct philosophical choices in how an entire economy approaches risk.
Moving on to Section 2, short-term money markets, the gears of liquidity. We've met the driver, so now let's see how that daily cash flow is actually managed.
Banks face mismatches in their cash flow literally every single day. The central bank controls this overall flow through what we call open market operations. Imagine the banking system is running dangerously dry on cash, while the central bank steps in and buys up government securities from those banks. This instantly injects fresh cash straight into the legal reserves held by those institutions. And that injection cascades all the way down. It shifts interest rates, it increases credit availability, and it expands the overall money supply. It is the principal, practical tool used every single day to hit big national economic goals like price stability. Now, what is truly fascinating here is how this dual system actually prices that short-term money. You've got to have a strictly maintained firewall between the two tracks. Over on the conventional side, banks lend to each other based on CLIBOR, the Kuala Lumpur Interbank Offer Rate. It's just a classic interest rate. But Islamic banks, they absolutely cannot touch CLIBOR because it relies on pure interest. So instead, they use the IIBR, the Islamic Interbank Benchmark Rate. This rate is strictly based on expected profit rates from real, actual economic activities. So you've got two completely different benchmarks functioning as the pricing gears, working perfectly to keep that firewall intact.
Let's break down exactly how the Islamic side pulls off this overnight lending without using interest. They use the Mudaraba Interbank Investment Scheme. Okay, so a deficit bank needs funds, right? And a surplus bank has extra cash. Instead of offering a standard interest rate loan, they negotiate a profit-sharing ratio, let's say 75 to 25. The surplus bank invests the money with the deficit bank. Then, at maturity, the profit that gets distributed isn't some fixed charge. It is based entirely on the receiving bank's actual declared gross profit from its investments. Just think about how revolutionary that is compared to conventional banking. Instead of a guaranteed, risk-free overnight return, these Islamic banks are acting as true business partners, sharing the actual economic reality of those investments.
All right, Section 3. Equities and Capital Markets. The Wheels of Growth. We're shifting out of those short-term gears and pulling on to the long-term avenues where true wealth is built.
We could sit here and talk about complex math and things like the capital asset pricing model all day. But honestly, the core truth of capital markets comes down to this. Their most vital function is to process and disseminate information quickly and cheaply. They intermediate between the surplus units looking to invest and the deficit units needing capital. By doing that, they provide instant price discovery and reflect the sum total of all market information. This is the exact place where long-term corporate risks are priced.
For the Islamic track, participating in these capital markets requires really strict Sharia compliance, and that means extensive screening. For a stock to be Sharia compliant, the company has to pass rigorous debt ratio thresholds and completely filter out any impermissible activities. We're talking no alcohol, no gambling, and no standard conventional financial institutions. But beyond just picking individual stocks, you should know that this ecosystem is fully mature. Investors have access to Islamic mutual funds for professional management, Islamic ETFs that offer instant, low-cost diversification, and even Islamic private equity funds. It mirrors the conventional side almost perfectly, but it operates under a very tightly screened mandate.
Now, I want you to consider the number 20%. Why does this specific threshold matter so incredibly much to international investors and financial regulators?
We'll take an Islamic real estate investment trust, or REIT. Let's say it owns a mixed-use commercial property, like a massive shopping mall. The management has to heavily audit every single one of its tenants. If some of the rental income comes from non-permissible activities, maybe there's a conventional bank branch leasing a corner space or a grocery store selling non-halal goods, that specific rental income absolutely cannot exceed 20% of the total mall rentals, period. If a single new tenant signs a lease and pushes that non-halal rental income to 20.1%, the entire REIT could literally lose its compliance status. Furthermore, no new tenants with non-compliant activities can even be added once you start approaching that line. That is exactly how rigorously these religious principles are codified into exact, unforgiving corporate financial thresholds.
Moving to our final section, Section 4, Bonds, Sukuk, and Debt, Fueling Long-Term Vision. This is how governments and massive corporations raise the serious capital needed to fund the future.
Look, a conventional bond is essentially an IOU. It is a pure debt obligation. You buy the bond, the issuer pays you fixed coupon interest, and honestly, they can use those funds for just about any general corporate need. But a sukuk? A sukuk is an entirely different beast. It forces the money to be tied directly to real, productive economic activity in the physical world. It actually represents ownership in an asset. Your returns come directly from the profit sharing generated by that specific asset, and every single dollar raised must be strictly used for identifiable halal activity.
By definition, a sukuk is an investment certificate that grants the investor a proportionate ownership right in a tangible asset. What's absolutely amazing to me is the historical lineage here. The term sukuk actually comes from the plural of sok. Back in the Middle Ages, the Umayyad government used a sok as a physical grain permit. It was just a simple piece of paper that entitled soldiers to receive physical commodities directly from the state treasury. And today, that ancient, incredibly practical concept of an asset-backed permit has leaped centuries forward. It's evolved into multi-million-dollar corporate financing structures and modern digital issuances like the 2020 Sukuk Prihatin. It is fundamentally a hybrid equity, deeply rooted in history, and is definitely not just paper deck.
But if you're an investor, you absolutely must read the fine print, because I'll tell you right now, not all sukuk are created equal. An asset-backed sukuk involves a true legal sale of the asset to a special purpose vehicle. If the company that issues the sukuk suddenly goes bankrupt, you, the investor, can literally force the sale of the underlying building or asset to get your money back. You have direct recourse to the collateral. An asset-based sukuk, however, that keeps the ownership with the original issuer. You just have a piece of paper and a promise based on their creditworthiness. It's essentially unsecured. And that massive difference in the risk profile, it drastically changes the required yield that global markets demand.
So, we've covered the central bank drivers, the short-term money market gears, the long-term equity wheels, and the massive sukuk fuel. But I want to leave you with a thought about the future. We know from summarizing all these lectures that digital assets are heavily debated. Some scholars view cryptocurrencies like Bitcoin as entirely prohibited because they lack intrinsic physical value. Meanwhile, the Securities Commission currently allows specific digital assets on highly registered exchanges. So my final question for you is this. As digital assets and cryptocurrencies continue to evolve, how will decentralized technology ultimately merge with our highly structured, deeply regulated, dual banking ecosystem? It is a massive challenge for regulators everywhere, and it's an absolutely fascinating space to watch. Thank you so much for joining me on this explainer. Keep learning, and I will catch you next time.